Okay, hello everybody, and welcome to another episode of the Capital Gains Tax Solutions Mastermind, Deferred Sales Trust Crypto Mastermind. It happens every Friday, 10 a.m. Pacific Standard Time. I'm one of your co-hosts, Brett Swarts, Gains Tax Solutions, where we believe most high net worth individuals and those who help them, they struggle with clarifying capital gains tax options, especially when it comes to deferring capital gains tax on cryptocurrency, businesses, real estate. And we have found a unique strategy called a deferred sales trust that we help people execute on when it comes to exiting highly appreciated assets. And I'm joined by my strategic alliance business partner, Jake Muller. Jake, how you doing?
I'm doing very well, Brett. Glad to be here. And you're in transit again, like you often are. You're presenting, and you took the family with you this time. Is that right?
We took the family with us, and we're here in one of the most beautiful locations in Southern California called Manhattan Beach, where we drove down from Sacramento, 6-hour drive yesterday to get to the conference. The conference is actually going on right now. I had to sneak out. Some amazing people on stage right now. Some very, very intelligent folks. I feel like I'm in the right room, right? If you can get around enough people that are smarter than you, you can really level up, and that's where I'm at. But Hunter Thompson is, if you haven't heard of that guy, he's an amazing commercial real estate operator, syndicator, and he has this conference every year. It's called the IRCC, stands for IIRC, Intelligent Investor Conference. And so, I'll be speaking tomorrow, which is really, really cool. And how about you, Jake? How was your week?
It's been an exciting week. I've been to Kansas. I go to Omaha. Then I'm going to go down to Oklahoma and meeting with some larger accounting firms and helping. One of them has a team of over 20 accountants, and just helping them understand the Deferred Sales Trust and do a deep dive into various other tax strategies that can help their clients.
Fantastic. And for those who are getting to know us for the first time, you want to just cover the vision of what we're going to cover here, and then we'll dive into the deal close story of the week, and then we'll open it up for questions. And we want to welcome Jonathan. We want to welcome Andrew. So why don't you kick it off, Jake, with kind of the vision of why we're here.
We're all here today because either we ourselves or our clients or somebody dear to us has had or is having or will have soon a large capital gains transaction, a large, highly appreciated asset that they are going to sell. And those people that have an eligible transaction as such, whether it's real estate, it's your home, it's stock options, it's cryptocurrency, there's a lot of different ways that you can go about selling that transaction, some of which have better tax consequences than others. The Deferred Sales Trust is our vehicle of choice for the majority of these types of transactions because of its flexibility, the control of timing of when you take contractual receipt, and the fact that for those of you who want to reinvest the proceeds, the gross proceeds net of attorney fees rather than net of taxes, we can snowball your investment while diversifying it into other asset classes and help you continue to grow your net worth.
Who does this work for, Jake? And, if someone's going to commit to like 20, 30 minutes right now to watching this, who does this work for quickly, and maybe who doesn't it not work for?
As an example, a fellow that I spoke with just the other day, he was looking at doing a charitable remainder trust. He was looking at doing a variety of other strategies, and it was very complicated and a lot of room for possible scrutiny because of the aggressive stance he was taking in other areas. His biggest concern was with the charitable strategies is that he's giving this money away and he's never going to get it back. His real desire was, I want to leave something for my heirs and for my legacy. So who does this work for, Brett? This works for your 45-year-old who wants to leave something to his kids and make sure that his wife's taken care of, while at the same time deferring the taxes of today so that he can continue to reinvest a much larger amount into a diversified portfolio of other assets. And when I say portfolio, I'm not talking only stock market or anything like that. This particular individual, he's selling shares in a corporation that he owns, and he wants some real estate, and he wants some crypto, and he wants a variety of other things that he can't do in any other vehicle except for the Deferred Sales Trust.
And being that he may be coming out of something that he's not an expert in, can the trust invest with experts that are like multifamily syndicators, self-storage syndicators, financial advisors like yourself, going to lending, going to real estate developments? Like, how flexible is it, especially if you're on the other side, if you're the expert who's trying to unlock capital for your next deal or next venture?
Absolutely. And the interesting thing about this particular client, Brett, is he is an expert in what he does, but he wants to leverage the knowledge and education of other people who know more than he does in other areas. And so that is why he's very much attracted to us. His CPA is one of the Forbes national advisors, Forbes magazine, Forbes Council nationally, and he brought this client to us so that we can help him and we can be those experts in these other areas. And absolutely, we don't compete with other professionals. We work alongside them. We don't step on toes. We help bring the average knowledge base in the room up a scale to the next level and make sure that everything the client's doing is taken care of. In fact, I help the client understand that the proceeds that you receive with this money, it's like it's going into another entity, because this is like a business trust, where you, Mr. Client, you're still the CEO. You're still in charge, but now you've got a CFO and you have a COO. Brett Swarts is the trustee. He pulls the trigger on all the actions that we take. And myself, I'm just here to provide witty comments, a few jokes here and there, and hopefully some good financial advice.
Yeah, fantastic, Jake. Yeah, absolutely. And so yeah, that's who it's for. Also, the minimum size deal is typically 1 million net proceeds, $1 million gain. And so whether you're selling Bitcoin, Ethereum, whether you're selling a GP position in an apartment complex syndication that you have, whether you have an LP position that you're selling, whether you're selling a primary residence, whether you get FAL 1031 exchange saved, we can provide all of that with a deferred sales trust. And the key here is to try to demystify it as much as we can on these weekly masterminds. Invite your CPAs, invite your business partners, invite your clients, come and learn how to do this. And once we believe once you demystify it and you really break it down to the simplicity of what it is, what it's not, it can be transformational for you as the owner of something that's highly appreciated, or for your clients or investors that you're looking to bring into your next deal. So that being said, I want to touch on a couple current deals that we've already closed with Bitcoin and Ethereum for those who are there. And then we're going to touch on an industrial property sale for the deal close story of the week. And so far we have closed 3 Bitcoin and Ethereum sales for a total of about 12.5 million AUM, and we've done it in the last about 100 days. And these were 2 separate, one single individual and 1 married couple, both in California. Both happen to be in the tech industry. Both work for very large tech corporations, both experts in all things like technology and all things cryptocurrency, to be honest. And that's how they had I call it the steel spine conviction to wait and to actually hold during the ups and the downs of both the real estate market and the crypto market and other things. And they had the fortitude to also dollar cost average into Ethereum and Bitcoin. And one of them saw their Bitcoin holdings go from about $50,000 to $50 million. And they never sold until they had a chance to defer the tax, which is where we came in and we provided the Deferred Sales Trust service. And we actually closed that deal, and that was about $1.8 million or so in tax deferred. And they were able to start a business venture with one of their business partners. But this happened, and the second deal was for a client who mostly had Ethereum, and he and his wife wanted to have some more flexibility. They wanted to be done with the W-2 job. They wanted to have more time to travel and also diversify. And the biggest thing for them was he was more of the risk taker. She's more of, not as much risk. At least not be unwise with what the capital could do for their family. They bought Ethereum and Bitcoin for about $100,000, mostly Ethereum, and it went to as high as 13 million. But during that travel, it went to 6 million. It went down back to 1. It went to 9 million. It went back down to 5. And over this time period, it became challenging for them to say, when should we sell? When should we not sell? And that's where they also met us, went through it, very detailed analysis, and they closed. And they liked it so much, they did another 2.5 million about a month and a half later. And so we have a total of 12.5 million. We have probably about, I would say conservatively, about $250 million in the pipeline that are set to, we believe, are going to transact here in the next 3 to 6 months. And so we're always going to share every deal that closes so that people can have a tangible feel for what's happening and how this is working. So I'll pause there. Jake, any thoughts on those crypto deals before I talk about the deal close story of the week, which is an industrial property in Northern California for a couple?
Yeah, I think, it's important to understand what are their options. I mean, if they didn't do this, what else would they be doing? I mean, technically, most people, so I have another dear friend of mine who, in a similar situation, he hasn't pulled the trigger on any of this yet, but he was typically planning on just, there wasn't any other option. Like, he had to pay the taxes now. So it's like, hey, I have all these positions, and a lot of people are trying to tell me, let's do it anonymous, let's do it off exchange, let's do all these other things, just for anonymity. The IRS keeps changing their mind, whether it's a currency, it's an asset, whatever. And so I guess, Brett, the thing that I would add is that we're helping people demystify stuff as new information is coming out all the time, helping people understand that, hey, instead of hiding the transactions, let's be fully transparent, and let's put forward a strategy that isn't changing, a strategy that's not being attacked or scrutinized, and let's roll, everything that is new and wonderful and evolving with crypto. Let's combine that with something that is rock solid, that has a proven track record, and let's be fully transparent as good accountants should, and let's show the government what we're doing in such a way that it should be all on board. And that actually has made a lot of people that we've spoken to feel much better about themselves and what they're doing, and about deferring the taxes so that they're not hiding anything.
Yep.
Anyway, I guess that was the point. I had another brief conversation this morning with somebody who's just said, hey, I don't know how I feel about all this stuff, because it's like, wow, but what you guys have shown me makes me, it's like I was so hesitant to move forward in all these different directions that I'm reading all these forums online and what I should do. And with what you guys have shown me, I'm definitely doing this.
Yep, there it is, right? And that's also why that is the exclusive focus, right? For now, there are also 1031 exchanges, Delaware Statutory Trust, Charitable Remainder Trust, but those, they all have their place. But the key is what's right for you. And most often, with what we're seeing is the Deferred Sales Trust for a number of reasons, which mostly being that folks don't want to give it all the way to charity, or the 1031 doesn't even qualify for this. So that's really the cool thing. And then plus it's 25-year track record, thousands of closes, billions under management, over a dozen no change IRS audits. And so it's not something that we're in beta, right? This is we've already blazed the trail. It's already been proven, already works. It has a perfect track record. And so we always say it's best to not take a risk with something that hasn't been proven. And that's why we love and highly recommend the Deferred Sales Trust. That being said, let's move to the deal close story of the week, and then we'll open up for questions. And by the way, if people have questions along the way, please do put it in the chat, and please, and then also or raise your hand. And so we can also dive into that particular question. Happy to do that. And it would also be cool to find out where everyone's from. If you can put that in the chat as well, open up a conversation so people can get connected with one another. We also want to provide the networking opportunity for folks that are on here. So it's not just me and Jake talking about ourselves, it's everyone else as well going to share what they do and how everyone can connect with one another. Because we have investors on here. We have multifamily syndicator experts. We have people that are learning about the Deferred Sales Trust for the first time, cryptocurrency experts, people that are investing in cryptocurrency as well for the first time. So it's a little bit of a mix. So that being said, it's a deal close story of the week. All right, it comes out of the town of Cameron Park. Who knows what Cameron Park is? I think Pierce does. Pierce, it was about 20 minutes from where you grew up in Granite Bay. It's about 30 minutes from where I grew up in Rockland. And it's a nice town, about 30 minutes out of downtown Sacramento, up Highway 50 as your way on your way to Lake Tahoe. So if anyone's been to Lake Tahoe, South Lake Tahoe, that is the way to go there. And you're going to pass Cameron Park. It's a bedroom community, good schools, nice community, golf course, let's say medium to higher income type of area. But these folks owned a commercial property, an industrial property, and they've owned it for a lot of years. And basically, we're fully depreciated. Commercial property depreciates about 39 years. But they didn't buy it for very much. I think they bought it for around 500, and they've owned it for around 20. And so their depreciation was somewhere around, or adjusted basis was somewhere around 150,000 or so. And they're looking to sell the asset for 1.3 million. Their motivation for selling was retirement. They wanted to be out of it was a multi-tenant industrial building. It wasn't overly complicated. It just was time to take their ROE, which was their return on equity, which was on this asset wasn't as favorable as it could have been, but also slow down a little bit and just diversify. And so they sat down and looked at the deferred sales trust, looked at their tax liability, and they said, you know what, we do not want a 1031 exchange because we don't want to start over with new toilets, new trash, new liability, new tenants. We'd actually like to be more passive. And so, but they have a lot of tax. Their background also too, they've done a lot of first trust deeds. They've done a lot of they've also done some passive, but mostly through passive, doing it through a broker out of the Bay Area that's done this for many years. So they're used to having a little bit of both, being active, being passive. And so where they're at in their stage of life, they're ready to sell. But on $1.3 million sale with about $150,000 basis, and they have no debt on the property either. They have about a $1.15 million gain in California with state, federal, Obamacare, and depreciation recapture. Combined, it's about 40%. Okay, 40%. So it's $460,000 of tax liability that if they sold and did not do a 1031 exchange, did not do a deferred sales trust, or any other kind of tax deferral strategy, they're looking at $460,000. And so I think they found about the deferred sales trust on YouTube, maybe on one of these, probably one of the podcasts or one of the videos I've made. And so we went through it all, sat down, yeah, we just closed. They just closed yesterday. What's interesting about the deal is they're actually going to carry back some paper in order to make the deal work. So they're carrying back a substantial amount, but it's only a 2-year note just to get the deal done. But what's cool is the note is the payments from that buyer that they're carrying back are going to pay into the trust. And then the balloon payment's going to come due in 24 months. They do think it's going to pay off in 6 to 12 months. And then they're going to roll all of that into the trust and then just continue on. So at the essence of what we're doing here at the Deferred Sales Trust, it's just an installment sale. It's based on IRC 453, where you become the lender. And so in this scenario, they become the lender to the trust for a portion of the funds. About in this scenario, it's actually pretty low. It's only like $150,000 at first into the trust. Then the other amount, the remainder, is going to go into the trust over time, slowly. And so they are a lender to both the original buyer and to the trust. But eventually, when the original buyer pays it back, we'll go into the trust. So all that being said, they're really happy. They're really excited. They're planning on doing mostly stocks, bonds, and mutual funds investing to start with, and then eventually roll some of it into hard money lending, which is where they feel good. That being said, Jake, you want to pull any nuggets on that deal?
So I think the power of this is it's not just the trust that's going to own all the assets in the future. It's such a flexible tool. And actually, from a tax standpoint, one of the preferred methods is kind of what you've been describing, Brett, the joint venture relationship that we can have with other entities that you own or other entities that other people own. And that the deferred sales trust can insulate itself from liabilities of other operating businesses if necessary, and participate as a lender in exchange for a contract and everything else. And, whether the assets are inside the deferred sales trust or outside the deferred sales trust for purposes of depreciation, depletion, amortization, whatever else that you might benefit from outside, the flexibility and the level of sophistication is there with you with this executive team that comes with the deferred sales trust. And we're there to kind of guide you through the most efficient process from a tax consideration, as well as for achieving your overall objectives. And that's kind of one of the big things that Brett and I help people do going forward with the deferred sales trust is, first and foremost, you've got an eligible transaction. Okay, so you can do it, but what are your objectives? What is it that you hope to accomplish? And with that view in front of us, for and foremost, we then go through all of these different strategies and work through what is most convenient for the client.
Yeah, I like to say it's like a Rubik's Cube, right? And when we first start, you come in with this cube, and this cube has all the different colors on all the different sides, right? And you show up, you're like, gosh, I don't know how to set this capital gains tax. I know I have this vision for where I want my wealth to be, this vision for the freedom for my time and my energy, this freedom to build this real estate deal, this freedom to raise this capital for this deal. Here's this Rubik's Cube. It's all disjointed with different colors, and you hand it to me or Jake, and we start to work on it. And we start to hopefully get some colors lined up, and then I hand it over to Jake. Jake does a little bit more. And then we hand it over to the tax attorneys, and they do a little bit more. And we hand it back to you, and you do a little bit more. And as a team, we're working out, and hopefully, eventually, we get congruency, which meaning each side of the cube has the same color as much as we can, with tax deferral, with liquidity, with diversification, with freedom for optimal timing to invest in different things, with being passive or being active. All of those things are also going to adjust along the way as well, which is also cool about the deferred sales trust, because you might start out and say, I want to be passive for a while. And fast forward, you might want to be active in 6 months or 12 months or 24 months when you find a deal. Right? As long as the funds are in liquid investments with the trust, which they can 100% be, then it can be accessed and moved into illiquid deals with you. So it's the flexibility and the ability to adjust it along the way based upon what you're looking to do, and realizing that it's not set in concrete, but working with us, we're going to help and guide you through that step, each step of the way. So that being said, I want to open it up for questions or thoughts from anybody. I want to welcome Andrew. I want to welcome Jonathan. Let's see, who else do we have on here? We have Pierce. I think I think Vijay is here. We have Leah. We have Pete. We have the Ferrari Conduit, which is kind of cool. I'm not sure if that's a cool name. We have Adam. So does anyone have any questions or thoughts on anything we just said? Comments? It looks like Adam does. Adam says, I can only do the chat today. Does the trust pay for any taxes is the first question. Does the trust pay any taxes? I'm assuming not, because it makes no gains when selling property, correct? Is it possible to describe how the trust is not paying taxes to the transaction? That's a great question. I'll start it off, and I'll have Jake also talk about this as well. So the unique part about the deferred sales trust is it does pay taxes to the extent it actually has taxes to pay. Now, with any business venture, if you have income and expenses, and if your expenses outpace your income, you operate at a loss or at a neutral state. And that's the cool thing about the deferred sales trust, is that it often operates at a loss. And you might ask, well, Brett, how does it operate at a loss if it's supposed to make this return? Well, part of what it can do, it can accrue the interest of what it owes you. So let's give you an example. So let's imagine it's $1 million trust, okay? And it's set to pay you about 8%, which is what a lot of our trusts are set up as. It also has expenses of somewhere between right around 2% per year, okay? But that 8% that's owed to you can be expensed, as well as that 2%, as well as the tax return. So what often happens is it operates at a loss on every single year. Therefore, the trust does not have to pay any tax at the tax level. So that's post-close. Pre-close, it's buying the asset or the assets being assigned to them at $1 million and selling it to the ultimate cash buyer, or liquidating to the Kraken exchange or whatever exchange that's going to be buying the cryptocurrency. Therefore, it has the same basis. In other words, it received it for $1 million and it's selling at $1 million. So it's operating at a zero gain there. That's how it's able to defer the tax. So those are the kind of the two ways. So the real answer to your question is, even if it makes income, it's typically not outpacing the 8% and the 2%, and it's able to accrue that expense over the years. And you'll actually be able to see this as a deferred sales trust client of ours. You're actually going to see all of the tax returns for the trust, and you're going to see the income. You're going to see the expenses. You're going to see the carry forward accrual, and on a year by year basis, you're going to be able to watch this. That being said, Jake, you want to also say the exact same thing or something similar to that, so people can hear you say it as well, because you're probably going to put it even better than I can.
Well, I don't know that I'll repeat all of it, but with the deferred sales trust, I would like to add this little piece that, again, So some of these people, this is a life-changing event, or this is one of the largest transactions that they have. Or for a few clients, like the individual we spoke to the other day, he's going to have a series of like 53 of these transactions, right? So everybody's in a different scenario. And I guess what I'm trying to say is this is not a cookie cutter program. That first and foremost, yeah, there is this eligibility thing. It needs to be sizable enough. The pain point for getting in at least $1 million in a transaction, where the bulk majority of it, if not all of it, is subject to capital gains, because you don't have a whole lot of basis. You don't have, some of these other things that might offset the tax ramification. Now, if the tax ramification, if the pain of, if I'm going to do $1 million and I'm going to pay 20% in capital gains tax plus this 3.8, Obama thing and all this other stuff, if you're going to lose a big chunk of the overall pie that you own right now to taxes, but you could defer those taxes and just pay some attorney fees and different things. Now you've got a team of individuals, Brett and I, to help you maneuver through all the different strategies that might be applicable for your benefit. We can reinvest the bulk or the gross amount net of attorney fees rather than net of taxes, and help you snowball or grow your overall net worth. Now, net worth, that is a more of an arguable point, because sometimes if it is sizable enough, we actually move this out of your estate. And so we're growing the assets, even though we're able to keep it out of your taxable estate, depending on the size of your overall net worth today. And again, that just goes to explain the importance of this needs to be customized to your specific circumstance so that it is an optimal result based on your life and your objectives and what kind of transaction. If it's one transaction, if this is the singular largest and only of its kind transaction that you're going to experience, or if you're going to repeatedly have transactions like this going forward.
Very good. Thanks, Jake. It's like Jonathan has his hand raised, so I'm going to ask Jonathan to unmute himself and we can get his question, and then we'll also get to Pete. I saw your question in the chat, and we'll get to you in a second, Pete. Okay, go ahead, Jonathan.
Hey, everybody. I'm John. I'm in Charlotte, North Carolina. I had a question. The trust type, would this be an irrevocable trust?
So it is a business trust, and it is a version of irrevocable business trust.
Okay.
And that is how it is outside of your estate.
Okay.
Part of how it's outside of your estate, exactly, which is really kind of unique. Keep going, Jonathan.
Okay.
I would say that again one more time, Brett, because it came through muffled.
Yeah, I'd say it's part of how it's outside the taxable estate, which is proprietary and kind of another layer there. But keep going, Jonathan.
If you were, let's say, a partner in a private business like a doctor's office, and private equity is you're liquidating to private equity, would that be something that would potentially be eligible?
Yes.
Yes.
Okay.
Yeah, and here's the key. It's 1 million net proceeds, $1 million gain, unless you have two transactions that are 500 each. So let's say you had $500,000 of crypto and $500,000 of a GP position. You can combine the two in a short period of time, then you're eligible, okay? And so we like to see the trust really work hard for you, which means it needs to have enough liability to defer, tax liability to defer, as well as enough equity to sustain itself, because it is a business trust, right? And so that's what we found, that home run number, that 10 out of 10, we believe the number is, no matter what state you're in, what asset you're selling, is $1 million net proceeds, $1 million gain, unless you have two assets that are 500 or better. So yeah, it works for carried interest. It works for business sales. It works for LPs. It works for LLCs. It works for we've done orthodontists. We've done dentists. We've done optometrists. We've done Bitcoin. We've done Ethereum. We've done multifamily. We've done hotel sales, car dealerships, public stock, private stock. As long as it's big enough, you have a big enough gain, then we think it's a home run. Does that make sense, John?
Okay. And then the last question here, maybe you could just explain when it's getting interest, because obviously most of these people are selling, and yeah, it's their largest asset, but they're looking to generate an income stream off of that. So then at that point, would that interest, it would be taxed, or you would also, I guess, maybe realize a portion of the gain? Maybe you could give me an example, like when.
Are you asking when do you pay the tax? Is that what you're asking?
More so like if it goes into this business trust irrevocable, but they still would like to generate cash flow off that for their retirement. Is that?
Oh,
is
yeah,
that
yeah. So the trust has got to pay you back, right? So whatever you put in there, you're lending the funds. So I want you to think of yourself like a lender, John. You're becoming the bank. So you were an owner of the asset. And how this is working is you're taking 100% seller carryback financing for the trust.
Okay.
So there's three parties. And I think this will dovetail into Pete's question, which he's asking, how does it work for cryptocurrency? Okay, so I'll kind of walk through this for a cryptocurrency example and for our actual client. And so they had $50 million of Bitcoin, and they wanted to exit 5 million of it. This is Jake and I's client. Okay. And they're faced about 1.5 to 1.8 in tax liability. Very low basis, very high gain, live in California. So instead of just literally just selling 5 million on Kraken, right, into their own name and taking that cash, which is a taxable event, or even potentially just, transferring that BTC to another coin, which could be a taxable event. We set up a brand new trust, and they do not own, right? They don't. In fact, it's a brand new single entity business trust that only does business with that particular client. And they actually transferred those funds to the trust, that 5 million, a BTC though, just transferred BTC 5 million worth, in exchange for a promissory note to pay them back 5 million in cash. Okay, so they gave up ownership by transferring it. And what they became an owner of is a promissory note. In other words, they became the bank. So it's not unlike, John, what you would do for your own house. If you have a house and like, hey, I'm going to buy this house, but I'm going to ask the lender, or the bank, Bank of America or whatever, to give me a loan for 30 years at 3%. In this scenario, they've asked the trust to pay them back that 5 million at 8% over 10 years, interest only payments. And for this particular client, we're actually starting payments of about $15,000 a month in about 2 months. So they delayed it a little bit. Okay. And in the meantime, it's compounding at 8%, just like if you weren't paying back your bank, you said, hey, bank, I owe you that 3%, 30-year AM over 30 years. But what if I just delayed payments for 6 months? They could do it. It's like a forbearance, if you will, right? That happened during COVID as well for some people. It doesn't mean you don't pay the interest back. It just means it's compounding and it's building up. So that's what our clients do. It builds up until they start receiving payments, at which point they start receiving tax. So back to this deal, we form the Kraken account, okay, in the name of the trust. They transfer the BTC to the Kraken account. They get the promissory note. The trustee immediately sells it to cash. It's like a simultaneous close. We close as quickly as we can. And the Kraken account received the 5 million in cash, of which then we send out to a U.S. bank, of which then it goes over to where Jake manages funds, which is Charles Schwab, is one option, which is where a lot of the funds went, of which he has a asset allocation created, customized for that client based upon their risk tolerance. And it's making sure we do it in that order. When the smoke clears, someone on Kraken, whatever, has bought the Bitcoin for 5 million. The trust has received the cash. The client has not received any of the cash. They're in a deferral state. They've received a promissory note. And now they'll slowly get payments back from the trust, and they'll pay tax over time. Does that make sense, Jonathan? Any questions there?
Yes. Is there restrictions on the schedule? And if they hold it till their date of death, would that get the stepped up basis?
Jake, you want to talk about any restrictions on the schedule, and you want to touch on the stepped up basis for John?
So John, throw me a scenario. Like, make it a real life example.
Yeah, the scenario. Okay, so I have, let's say I have a client. He owns 10 rental properties, and he bought them, most of them in the 70s. So as you imagine, some of them he bought for $20K, and they're now worth $400. So he's looking to liquidate those, and he wants to generate income for his lifestyle. He's in his 70s, but he really is looking for a way, to defer and then potentially pass it on to his beneficiaries if possible,
Okay.
without paying the tax.
So we have to weigh the pros and cons of a couple of different things, because if he were just to pass, then obviously there's a step up in basis to his heirs, correct?
Mhm.
right? So if he were just to
Right.
pass, I mean, subject to estate tax limitations, depending on the size and the dollar amount of everything, if it's within the current exclusion, which could change tomorrow, right? But if it's within the current exclusion, married, filing, joint of whatever that is like 22 million, what have you. It's a large number, right? With the deferred sales trust, once the assets go inside of it, I mean, we kind of lose the stepped up basis feature, because the deferral of what it would be taxable to him now, I mean, now there's a sales transaction. So that asset is being changed. Okay. But he could acquire another similar asset. So we have another client just like this, but the dollar amount is much higher. $100 million development. $100 million development that the tax attorney or the estate planning attorney that was working with him was trying to help him, because it's in a partnership with him and his brother, trying to help him devalue the $100 million development for purposes of estate taxes, which is a common strategy. But we were able to work with him, and we had some discussions that sounded very appealing to him. Some of these discussions were, hey, instead of trying to devalue the property because you're in a partnership, you maybe don't have all rights and authority and all this other stuff, right? What if we were just to sell the whole thing today? And yes, if we were to devalue it, then, a step up in basis would be on the devalued portion that would go to your heirs. But instead of looking at it that way, what if we were able to get a new depreciation schedule for your heirs? And so if the proceeds, the gross proceeds of the true value, the fair market value, were able to enter the trust, and you were able to get a promissory note against that, and yes, you're going to be having interest income because of that promissory note. However, the deferred sales trust can then do a joint venture with another LLC or whatever, and do another development and grow it even further and provide a new depreciation schedule. So there are pros and cons that we have to weigh. What is of most, based on the actual example with the actual numbers, does it make sense to just leave the assets for the kids because the father's 78 and he's got stage 4 cancer and everything else? Maybe he should just, and it's less than the 22 million exclusion, which we know will be for this year, then let's just let it pass to the heirs, right? There's no need for the deferred sales trust. But if it's more than the exclusion, or if we're afraid that the current legislation is going to change the exclusion for estate taxes and lower it, like it wasn't too long ago that it was 600,000, not 22 million, right? So
I want to add one other thing too, Jake, real fast. The kids can also step into their shoes with the deferred sales trust. So although the deferred sales trust doesn't actually give you a stepped up basis, because again, you became a lender, you're not an owner anymore, but the kids can inherit the promissory note via the living trust, and then they can just continue the tax deferral. They'll get taxed as they stay out, right? But they can just keep going, right? So it's not as if, and how many parents really want their kids just to cash out of everything that they've earned just I think the answer is yes, but also some people might say, well, no, I actually like that there's actually something there that's going to make them actually consider keeping the funds invested in the trust, living off the cash flow. So it's not necessarily a bad thing. And to Jake's point, the stepped up basis does not take away the estate tax, right? So the key is to get funds outside your taxable estate. The deferred sales trust, you can do it in one day on one exit without having to devalue, without having to do family limited partnership, without having to do life insurance, without having to do really anything. Just sell, exit. You get a promissory note. Your kids inherit it estate tax free. Okay, this is reserved for larger deals. Okay, so yeah, we're happy to see Jonathan. If you want to set up a time with Jake and I and your client to go through it, we can walk through the pros and cons. You can invite him to this mastermind. Okay, and we can certainly give a no cost analysis for that. That being said, I want to shift over to Pete here. So Pete, again, says, Pete, this is new to me, so thanks. How do I get taxable crypto accounts into the trust? I think I kind of answered that. Step 1, we form the trust. Step 2, we open up a Kraken account. If it's a major coin that's trading on like Kraken, especially, which a lot of coins are, right? Then we simply just transfer your major coins like a BTC or Ethereum or Ripple or XRP is not there yet. They've been restricted for a while. But if it's one of those major coins, so I'd ask you, Pete, is it ETH? Is it Bitcoin? What's your coin? Is it tradable on Kraken? If so, it's really, really simple. We've already worked through all of the stuff with Kraken. We can open up pro accounts very quickly in the name of the trust. You transfer it to the trust, and then we sell it. And we do that together. Just so you want to show the security of all that. We do it all together. We start with this very small amount. $10 of ETH, right? Just to make sure all the pipes are completely opened up and everything is connected to the bank to exit out. And we methodically do this together. Okay. So that we keep that safe. Is it necessary to sell the coins? Yeah, it is necessary to finally exit the coins once it's in the trust, right? Because that's how we get it to cash, and that's how we get the cash to the bank. So hopefully that answers the questions, Pete. And you're welcome to unmute yourself or just message in the chat. Happy to talk about that. So Pete, do you have more questions there? Does that make sense?
Yeah, that makes sense. Part of my angst with the industry itself really isn't vetted very well till the SEC allows that in America, at least. But I have quite a few accounts and I have 50 different coins, and they're not all on Kraken. They're all over the place. So I'm just wondering how that, if it's not on Kraken, for instance, some of my IRAs for crypto, the coins I want to buy, they're not on this one. So I got to go look at that one, and they're not on that one. Anyways, so the net aggregate, I'm not sure.
There is a solution for that too, Pete. It's a little bit more complicated simply because of things inside, outside of the United States, on different exchanges, on DeFi, off exchange, all of that stuff. And we have some other clients that we've been working with to come up with solutions for that situation. Though I would say it's more of the rare thing that we do rather than the thing that we do and we present to everyone here. And so happy to schedule a meeting with you offline to kind of go over some of those options.
Yeah, I'm just getting involved with you guys on a couple of real estate sales. That I'm a little guy, but I'm not a fan of paying that government tax right away until I want to. So thanks.
Yeah. And again, absolutely. That's one of the biggest things that sometimes we lose sight of is the control of, if you receive it into the trust, you decide when you take distributions. You work with the trustee to make those decisions, and based on other things that you have from a tax perspective, there might be a particular year that it's additionally advantageous to take more of a distribution because you're in a lower tax bracket. You have other things to offset it. And the power of timing is one of the most important aspects of the Deferred Sales Trust.
Right.
I had a question. I know it's being covered, but the difference, the DST difference here versus the Delaware Statutory Trust. If I could just get clarity with that.
Yeah. So a Delaware Statutory.
Take that.
Yes. A Delaware Statutory Trust fund is a fund, and there's a lot of them out there. It's considered a direct placement program, and it's an actual organized fund that has specific a specific coding with it, so that when you put your money into it, it is eligible for a 1031 exchange. And if you weren't going to do a 1031 exchange, then you wouldn't do a DST. A lot of the Delaware Statutory Trust funds. A lot of the Delaware Statutory Trust funds also have another fund that is just like it, that pays a higher percentage rate of return. And the difference is that the Delaware Statutory Trust fund is eligible for 1031 exchange to receive funds from property sales and to abide by the like kind rules. So if you sold a not something that you've ever lived in, because you can't live in a property and qualify for 1031 exchange, but if you sold like an apartment building, you could invest in a fund that has apartment buildings. The advantage of that is that you don't have to do the maintenance, you don't have to do all that other stuff. Now you participate in a pool with other people that invest in like kind properties with you. Now, the advantage of the Deferred Sales Trust is you're not subject to all the timing limitations of a 1031. I mean, Brett has a whole recorded series of 1031 versus DST. When does it make sense? When do you do both? When do you do one or the other? And I think that it would be very beneficial to go and watch some of those. But a fund is very different than a Deferred Sales Trust. A fund is a financial instrument that files papers with the SEC. A Deferred Sales Trust is just another entity. It's like a business trust that is put in between you and the buyer and the seller. It is not a fund, and it does not register with the SEC.
Okay. Yeah, because so I think I'm remembering now. The Delaware Statutory Trust is more of like a real estate fund. So everything is in like kind. At least within real estate of the property that you sold, right? So that's the biggest difference.
Yeah, it'd be very similar to a REIT with an extra wrapper on it for tax purposes to make it eligible for a 1031 exchange.
Okay.
Yep. And as a reminder, cryptocurrency cannot go into a Delaware, right? Remember, cryptocurrency is not investment real estate. 1031 Blockbuster or Delaware Statutory Trust is like a Hollywood video next to the Blockbuster video store. It's just in the 1031 family. And again, it's cool if that's you're selling real estate and you found a good deal and you don't mind not having liquidity, you don't mind having any control, you're going to be completely passive. Some big fees. I've done Delaware Statutory Trust. Okay, myself, I was Series 2263 licensed before. I gave those up because I'm a trustee now. Trustee can't be the financial advisor. Financial advisor can't be the trustee. So separate roles. But they do have their place. You can solve mortgage over basis challenges for investment real estate deals. And so we're doing hybrid deferred sales trust Delaware deals. We do those as well. So it's not completely. It's a good tool. Just realize for anything but investment real estate, it doesn't even work for them. So that being said, good question, Vijay. I also want to bring in Andrew here. I had a good conversation with Andrew this week, and I want to open up a little bit about what he's been talking about. And he's got a new deal that's coming out. Andrew, you want to talk about a little bit of that deal and the opportunity for folks in case they're curious about it?
Yeah, sure. Absolutely, Brett. Thanks for the call and the chance to share. Yeah, so our group, Nighthawk Equity, we try to find a number of deals a year. We don't always do that because we're pretty selective, but we found a really cool apartment building for our investors to come into. So this will be our 19th syndication. So we've done this a number of times. In the Northern Atlanta market, this will be our 5th deal in the nicer half of Atlanta. We got this deal off market, which is incredibly rare nowadays. We got it because of the relationship that we've had with these brokers. And what's really cool about this deal is the rent increases, which is the primary way that you can drive value creation, is a little north of $600 on average across all 214 units. And we're going to be achieving that by investing about $15,000 into each unit, renovating the units, making it better, also making some improvements to the exteriors. But it's a phenomenal value creation deal.
I'm going to pause there real fast, by the way, because that is amazing. And I dug into Andrew with good questions when we were talking about this week, and he answered them wonderfully. And that's the key here. Understanding that value add forced appreciation opportunities to us, to me, my background, for multifamily, for mobile home parks, senior housing, assisted living, I have found it's the best way to create wealth while not having to take as much risk, because you can literally go in there, add value, flooring, countertops, appliances, washer dryers in the units. He has a unique way of lowering expenses through water efficient program, which we'll talk about here in a second. But essentially, that's $600 of value is substantial, and it's hard to find that kind of difference. I mean, you see $100, $150, $50, but to get to $600 is remarkable to find. And so it's hard to find. That's part of why they're very selective, and Andrew's group and who they work with. And so, by the way, his business partner, his name is Michael Blanc. He's going to be a part of my book. Michael actually has a chapter. If you guys don't know who Michael Blanc is, you should. And he has a YouTube channel and a podcast. He's amazing. But Michael Blanc is going to be in the new book that's coming out. And so I highly recommend people connect. And also, I do have a client in the Atlanta area. They may or may not be on this actual call right now. I'll leave that up to them to see if they want to connect with you offline, Andrew. But that being said, this is an opportunity for the trust to invest a portion of its funds into something like this, right? To someone you can know, like, and trust, get to know, like, and trust Andrew. Accredited investors is important, right? That's also something to consider here. We ought to make sure we're accredited. But that being said, Andrew, you want to add anything else to the deal and also talk about the water efficiency thing, which is kind of cool.
Yeah, on the water thing, I mean, this is a fantastic opportunity. It's one of the reasons that I say, capitalism at its best is really when you benefit everybody, right? So at Nighthawk Equity, we're trying to benefit our tenants, give them better places to live, the community. So, we're investing into the quality of the community, new roads, getting good tenants in there, improving maybe old warehouse clubhouses, and then our investors. So we're trying to make all three of those constituents better. And, one way that we're doing it is through water efficiency. So you come into a property that's got 200 units and its water bill over the course of a year might be $500,000. We can go in there with low flow toilets, aerators on the showers and the faucets and the kitchens and the bathrooms, and cut the water bill. We've done this about 5-6 times, almost in half, right? So you cut the water bill in half, you've dropped $250,000 down to net operating income. And when you apply that savings against capitalization rate on the property, you've almost a better return. We're saving water. We're really kind of there's wins all around. So that's one of the things that we've been working on in our properties.
So Andrew, how can people find you if they want to connect with you?
Yeah, I'll throw our firm is called Nighthawk Equity. I'll throw the registration link for our upcoming deal in the chat here. We have the event. The webinar is this upcoming Wednesday, the 26th at 8 p.m. Eastern. And we're just going to walk everyone through the story. It's about an hour-long call. Here's the deal. Here's how we found it. Here's how we're going to add value. Here's our track record. Awesome. And then people can sort of just make their own decision.
Perfect. I'm going to bring in Pierce now because we're going to be man on the street tomorrow in Manhattan Beach. This is our first time. We're taking that whole thing. You guys see the guy who's like, he's in New York and they're making like interviews. They're walking up to people. So Pierce is going to become the man on the street for Newport luxury real estate. We're going to do Manhattan Beach tomorrow with another strategic alliance. And we're going to be filming this like YouTube superstar style, right? So we're going to have 2 video cameras going. We're going to be talking. We might even talk with the owners. And so it's going to be kind of cool. But basically the envision is this to literally bring it to life, to walk it, to say, you're selling your house for $10 million. Do you know that you're about to pay $2 million in tax? Yeah. When you listen to with the realtor, does they know about the Deferred Sales Trust? No. Right. And that's the key to like literally change people's lives on the spot. I think of it like this, Pierce. I don't know what you're thinking. Like, and Pierce, by the way, I'm looking at him. He's in the conference. He's right over here. He's sitting on the other couch, so we can't be too close. But Pierce, do you remember those ones where they knock on the door and they're like, you just won like the sweepstakes, right? Like, congratulations. Like, here's a $10 million check. Like, we should maybe do like a play on that where we can have like $1.5 million check and be like, congratulations. Like, what are you talking about? Well, if you use the Deferred Sales Trust, when you sell your house, you can defer millions of tax. So Pierce, what do you think about that? How excited are you about that? What's that going to look like tomorrow?
I love the big check idea. That's fantastic. Hand somebody a big check, be like, hey, when you list with me, you'll save $500,000 or $1 million in tax. It's brilliant. I'm excited to get that rolling. I think it's a great idea, and I think it's unique. And I don't see other realtors doing that for sure. So that'll be awesome.
Pierce, if someone wants to list and sell and save millions of tax on their luxury real estate in Southern California, what's the best place to find you?
Yeah, you can find me on my website, kingdomluxuryrealty.com, and then I'll throw my info in the chat box here, right next to Andrew's.
Excellent. And then we're running out of time. So Jake Miller, if people want to connect with you, it's best place to find you, Jake.
Yeah, so just give me a call, 1-800-773-1848. Again, 1-800-773-1848.
And then Pierce's number is what's that, Pierce? 916-879-0903, and that's Kingdom Luxury Real Estate.
Shoot, that's
is that a different number? Pierce is putting wrong numbers in here. He's putting his wife's phone number in there. Don't do that, Pierce. I'm just kidding. It's probably not his wife's number, but 916-878-0903 for Pierce. So I want to encourage everybody. I'm going to answer one last question from Adam regarding the distribution on how it's taxed. But I want to encourage everybody to keep coming back here and to keep on asking good questions. Subscribe to our YouTube channel. Be on the lookout for the new book, Building a Tax-Deferred Exit Strategy. By the way, our latest chapter besides Michael Blanc is the Jake Muller. In fact, we're going over the manuscript right this last few days. So he'll be in chapter, like the first few chapters, which is going to be awesome as well. We have Kevin Harrington from Shark Tank. So look for this in about 30 days. But again, we just want to give you as much resources, as much tools, as much opportunity, content to make this simple and to hopefully increase the know, like, and trust with all of us and what we're doing here and why it could be an amazing thing for you or your clients. So please do come back. Please subscribe to the podcast, the YouTube channel. Share this with somebody who can literally change their life, right? By selling high in cryptocurrency and business and real estate, deferring millions of dollars in capital gains tax. And so they can give more, they can save more, they can invest more, they can start that next part of their life or their chapter of their wealth plan. And then if you want to connect with us, go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. And then we'll see everybody next week. Hopefully, bring a friend, bring your CPA, everyone's invited. I'm still getting David Young lined up for those who are wondering about that. And that being said, I appreciate everybody, and we'll talk to everyone soon. Okay, bye now.